Welcome, everybody. It's great to have you with us today. I'm Chris Ashton, head mentor at the Corellian Academy, and this session is all about bringing more clarity to using option CFDs on the Plus500 platform. Like standard CFDs, they use margin, but as we covered in our first option CFD webinar back in January, their behavior is driven by changes in the premium of the traditional option, not the underlying asset itself. Understanding that difference is essential if you want to use them effectively. In that first session, we laid the foundations of how option CFDs work, what drives their price, and how they can fit into a structured trading approach. Today, we're building directly on that groundwork. We're going deeper, more practical, and more market focused. If you missed the first session or you just want a quick refresher, use the link in the Zoom chat. It will take you straight to the Plus500 YouTube channel, where you'll also find additional sessions on risk management and major markets like the S&P 500, gold and oil. Right? Stay focused, keep learning, and let's continue sharpening your understanding of option CFDs. Now, in today's session, we're going to start by breaking down the core differences between standard CFDs and option CFDs, because although both let you express a market view, they behave very differently. From there, we'll jump onto the Plus500 platform itself, show you where to find option CFDs across commodities, indices, FX pairs, and individual shares, as well as looking at how you can chart their movement. We'll then move on to explore the differences between the weekly and monthly option CFDs that you have available to trade on the Plus500 platform, looking at how they behave differently in certain scenarios and how you can match each one to your individual trading style. And then finally, we'll finish with a look at the flexibility of buying and selling both call and put option CFDs. Before moving forward, just some quick housekeeping notes. Today's presentation will run for around 20 minutes. We'll finish with a Q&A, so feel free to drop your questions into the Zoom chat or the Q&A box at any time. And please note that trading CFDs carries risk, and everything we cover today is purely for educational purposes. It's not financial advice. Right, let's get started. So to begin, let's clarify the core differences between a standard CFD and an option CFD on the Plus500 platform, because although they both let you express a market view, what happens after you place the trade can be dramatically different. A standard CFD is the simplest structure. You're trading the price movement of the underlying asset itself, whether that's gold, euro, dollar, or Apple. If the underlying moves up, your CFD moves up. If the underlying asset moves down, your CFD moves down. It's a direct one-to-one relationship. Your profit or loss comes purely from direction. There is no volatility component, no time decay, no premium behavior to interpret. It's pure directional exposure. And because you're using margin, you can control a larger position with a smaller initial outlay. But the mechanics remain simple. Your P&L is driven by the underlying asset and nothing else. Option CFDs work differently. Here you're trading the movement in the premium of the corresponding traditional option and not the underlying asset. That premium is influenced by direction, where if the underlying asset moves, the option premium usually moves with it, but not always at the same speed. Sometimes the option moves faster than the underlying, and sometimes it moves slower. Then there's volatility, where even if the underlying market doesn't move at all, the option premium can rise or fall simply because volatility changes. This means you can be right on direction, but still lose money if volatility collapses. And then there's time decay. Every option has an expiry date. As time passes, the option premium loses a portion of its value, even if the underlying asset price doesn't move. This is called time decay, and it accelerates as expiry approaches. We went into more detail on these points in webinar 1. So, as you can see, more factors drive the price of an option CFD. This means you can take a view not only on where the market is heading, but also on how volatility might change or how time might affect the option's value. You're still using margin, but the behavior of the product is more sensitive and multi-dimensional. A really important point to grasp is this. Option CFDs often allow you to take on a much larger position with the exact same margin. simply because option premiums are usually cheaper than the underlying asset. If we use Apple as an example, a call or put option CFD can often cost just a fraction of the price of the underlying share. And that lower entry cost means your margin stretches further, giving you exposure to a far greater number of contracts. And that's where the power and the danger of option CFDs comes in. Because when your position size increases, every tick in the options premium is multiplied across more contracts. That can translate into bigger, faster profits, but it also means losses can accelerate just as quickly. So while the lower cost of entry is a major advantage, it also demands discipline. It needs to be built into your position sizing, your risk limits, and your overall trading process. Otherwise, the very feature that creates opportunity can just as easily magnify your risk. Let's bring this to life with a simple example using Apple at $250. If we look at the standard CFD first, with a 1 to 5 leverage, your 1,000 margin controls a $5,000 position. At $250 per share, that gives you 20 Apple CFD contracts. If Apple rises by $10, your profit is 20 times $10 equals $200. It's a clean, linear gain because you're trading Apple's price directly. Your P&L is driven purely by direction and your exposure is fixed and predictable. Now let's compare that with an option CFD, and this is where things start to get interesting. With an option CFD, you're not buying the actual option. You're trading a CFD whose price tracks the option's premium, and your P&L comes entirely from movements in that premium, not the underlying stock itself. Let's set up a simple example so you can see how this plays out in practice. We're using an Apple call with a strike price of $250. The option CFD price is $13. The margin required is $1,000, and your leverage is again 1 to 5, which means you're controlling a $5,000 position. Now, this position size enables you to have 375 option CFDs. So with the same $1,000 margin you used for the standard CFD, you're now controlling 375 contracts, a dramatically larger position simply because the option CFD price is far lower than the price of the underlying Apple share. Now let's see what happens if the Apple price moves. If the Apple price rises from $250 to $260, the option CFD might increase by around 3 points. Here's the P&L. 375 contracts times a $3 increase equals a profit of $1,125. So compared with the standard CFD's $200 gain, the option CFD delivers a much larger return on the same margin. This is because every tick in the options premium is multiplied across a much bigger position. But the flip side is just as important. If the option CFD's price falls from 13 to 11, that's a 2-point drop. Your P&L becomes 375 contracts times -2 equals a $750 loss. Again, the move is amplified because of the larger position size. And this is the key message. Same leverage, same margin, completely different behavior. Option CFD prices move faster, they're more sensitive, and they react to more than just direction, which is why the swings in P&L can be significantly larger than what you see with a standard CFD. And this is exactly why risk management becomes a key difference between trading a standard CFD and an option CFD. Once you understand how dramatically their behavior diverges, you start to see that the way you size, monitor, and control each position must be completely different. With a standard CFD, your risk is tied directly to the underlying market. If Apple moves $1, your CFD moves $1. It's linear, it's predictable, and your exposure is easy to calculate. But with an option CFD, the risk profile expands. You're dealing with a product that can move faster, react to more variables, and amplify both gains and losses through larger position sizes. Let's break this down a little bit more clearly. With standard CFDs, your position size is naturally limited by the price of the underlying. If Apple is $250, you can only buy so many contracts with that $1,000 margin. With option CFDs, the premium might be 13, it might be 5, or it might be even less. That means your margin stretches further and suddenly you're holding hundreds of contracts, not tens. That's fantastic when the trade moves in your favor, but brutal when it doesn't. Every tick is multiplied across a much larger position, and that's where traders sometimes get caught out. And this is why option CFDs position sizing becomes so crucial. Standard CFDs don't have to account for volatility. If the underlying asset doesn't move, your CFD doesn't move. Option CFDs are different. Even if the underlying market stays completely flat, if volatility rises, the option premium can increase. If volatility falls, the option premium can drop. This means you can be right on direction but still lose money because volatility collapsed. Or you can be wrong on direction but still make money because volatility has spiked. Volatility is a second layer of risk and opportunity that standard CFD traders never have to think about. Next, every option CFD has an expiry date. And as time passes, the options premium naturally erodes. This is time decay, and it accelerates as expiry approaches. So even if the market is flat, the option CFD price can drift lower simply because the clock is ticking. Standard CFDs don't have this problem. You can hold them indefinitely without the price decaying. With option CFDs, time is always a factor, and it must be part of your trading plan. Another factor to consider is option CFDs move faster than the underlying asset. This acceleration cuts both ways. Bigger equals faster profits, but bigger can equal faster losses. Because option CFDs can move quickly, your margin can be consumed faster than you expect. If your equity drops too far, the platform will automatically close the position to protect your account. This is not a failure, it's a safety mechanism, but it means you must consider sensible position sizing, avoiding over leveraging, monitoring your equity buffer, and using stop loss tools consistently. Option CFDs give you power, but they also require respect. Now let's briefly walk through exactly where you can find these products inside the platform, because Plus500 have organized everything in a way that's easy to navigate. Let's start with commodities, where weekly and monthly option CFDs on major commodities are available. These include gold, oil, natural gas, silver, and Arabica coffee. You'll find them on the left-hand side of the platform under commodities. Inside that category, there's a dedicated options list where each commodity has both call and put option CFDs available, as you can see on the screen right now. This gives you a clean, simple way to trade direction, views on inflation, risk sentiment, or macro events, all through the same CFD interface you already know. Next, Plus500 also provide option CFDs on the world's major indices: the S&P 500, the Nasdaq 100, Hong Kong 50, UK 100, and the Germany 40. You access these the same way through the indices category, then into the options subsection, and here's one of the most powerful features. You can also chart option CFD price movements exactly like standard CFDs. You can apply technical indicators, draw trend lines, analyze support resistance, and study price behavior directly on the options premium price movements. As an example, when you open a S&P 500 call option CFD chart, you might see the premium repeatedly bouncing off a support or struggling to break above a resistance level. Now you can apply the same technical analysis you already use on indices, but you can do it on the option premium movement itself. Plus500 also offer option CFDs on major FX pairs, including euro-dollar, the most heavily traded currency pair in the world. You'll find these under the Forex category on the left-hand side of the platform, again within the options section. This gives you a way to trade interest rate expectations, central bank policy shifts, or volatility in currency markets without managing CFD spot positions. And then finally, you can trade option CFDs on some of the biggest companies in the world, names like Nvidia, Alphabet, and Apple. These sit under the shares category, where each supported stock has its own list of call and put option CFDs. This is incredibly useful for CFD traders because option premiums often react faster and more dramatically than the underlying share price, especially around earnings, product launches, or major news events. Option CFDs give you a way to express directional or volatility-based views on these companies without needing to trade the shares themselves. It's the same familiar CFD interface, but with a completely different set of opportunities. Now let's explore one of the most flexible aspects of option CFDs on the Plus500 platform: the choice to use weekly or monthly options, depending on the style of the opportunity that you want to capture. And this really matters because the choice between the two completely changes how the option behaves, how fast it moves, and how you manage the trade. Weekly option CFDs are like the sprinters of the options world. With only a few days left until expiry, they react instantly to whatever the market is doing right now. A small move in the underlying asset, a sudden volatility spike, a surprise headline, weekly options feel it right away. You typically reach for weekly options when you're trading major economic data releases, earning announcements, short-term volatility bursts, news-driven market shocks, or rapid intraday momentum. Because they carry almost no time value, weekly options behave like high-performance instruments. They're cheaper to enter, more sensitive to market movements, faster moving in both directions, and highly reactive to volatility changes. They're designed for traders who want speed, precision, and short-term opportunity, the kind of setups where timing matters and the market is moving now, not next week. If weekly options are the sprinters, then monthly option CFDs are the marathon runners, steady, controlled, and built for traders who want time on their side. With weeks until expiry, monthly options don't panic at every tick. They move with purpose and not impulse. They give you room to think, room to plan, and room to let a broader market theme play out. Now, you typically use monthly options when you're trading multi-period trends, broader macro themes, medium-term directional views, volatility expectations over time, or swing trading setups that need some breathing room. Because they carry more time value, monthly options behave like more well-balanced instruments. They're slower moving with a smoother price action, less sensitive to intraday noise, more stable during volatility dips, and more forgiving if the market takes time to move. They're ideal for traders who want structure, stability, and a calmer P&L curve, the kind of setups where the story unfolds over days or weeks, not just in minutes. Let's look at two scenarios for using a weekly or monthly option CFD. Scenario 1, trading the non-farm payroll shock. It's a Friday, it's US non-farm payrolls, and that data is due in 30 minutes. The S&P 500 has been drifting sideways all week, but traders know this number can ignite volatility instantly. A trader spots a setup with volatility starting to rise. The index is coiling in a tight range. A breakout is likely one way or the other, and the event is minutes away. They choose a weekly S&P 500 call option CFD because it's cheap, it reacts instantly to volatility, and they only need exposure for a few hours. As well, they want maximum sensitivity to the event. Scenario 2 is positioning for a central bank cycle. The ECB is expected to cut interest rates in 3 weeks' time, and euro dollar has been drifting lower, but the trader believes a medium-term reversal is coming. They choose a monthly euro dollar call option CFD because the catalyst is weeks away. They want exposure through the entire build-up. They need stability, not intraday noise, and they want slower time decay. As expectations shift, the euro gradually strengthens, the monthly call premium increases as both direction and volatility move in the trader's favor. A long, steady run, exactly what monthly options are built for. So to summarize, weekly options are for moments, speed, sensitivity, event-driven setups. Monthly options are for movements, stability, time, trend-driven setups. All right, now that we've looked at how weekly and monthly options behave, let's unlock one of the most powerful parts of option CFDs on the Plus500 platform. You're not restricted to just buying. You can also sell call and put option CFDs, and that opens the door to bullish, bearish, or even volatility-driven strategies, all without ever touching the underlying asset. When you buy option CFDs, whether it's calls or puts, buying is the classic straightforward play. You're positioning for expansion. You want the option CFD price to rise. Buying a call option, it usually occurs when you expect the underlying market to move higher, you think volatility will increase, and you want leverage upside exposure. A rising market or rising volatility pushes the call premium price up, and that's exactly what you're trading. When you buy a put option CFD, you expect the underlying market to fall, you think downside volatility will increase, and you want to profit from weakness without shorting the asset. A falling market or rising volatility usually will lift the put option CFD premium price. The bottom line, when you're buying, you want the option CFD price to go higher. When you sell option CFDs, whether it's a call or put, selling flips the script. You're positioning for contraction. You want the option CFD price to fall. You usually look to sell a call option CFD when you expect the market to stay flat or to drop. You think volatility may fall, and you believe the call premium is overpriced and likely to decline. If the market doesn't rally or volatility cools, call premiums usually shrink. And with a sell, well, you usually look to sell a put option CFD when you expect the market to be stable or to rise, you think volatility may drop, and you expect the put premium to fall. If the market holds steady or the underlying asset moves higher, put premiums usually contract. Bottom line, when you're selling, you want the option CFD premium to go down. So the big takeaway is this. When you buy options, you're positioning for expansion. You want the premium to rise. When you sell options, you're positioning for contraction. You want the premium to fall. Buying lets you ride momentum. Selling lets you fade momentum or volatility. They're two distinct approaches built into the same instrument, and together they give you a full spectrum of strategic choices. Now, as we wrap up today's session, I hope you're leaving with a much clearer, more confident understanding of how option CFDs behave and how they can expand your trading toolkit when used with discipline and purpose. These products open the door to directional, volatility-driven and time-sensitive opportunities that simply don't exist with standard CFDs, but they also demand a sharper approach to position sizing, position timing, and risk control. The more you understand the mechanics, premium behavior, volatility shifts, time decay, and the impact of position sizing, the more strategically you can use these tools across commodities, indices, FX, and individual equities. So keep refining your process, use the demo platform if you want to practice, keep building your edge, and keep pushing your knowledge forward. Thanks for joining me today, and I look forward to seeing you in the next session as we continue to level up your trading skill set together. Right, let's move on to the questions.